You're buying a home in Texas and your lender tells you that your monthly payment is going to include something called an escrow account. Maybe you've heard the word before, maybe you've even been told, don't worry about it. But what if I told you that your escrow payment could increase hundreds of dollars a month even if your mortgage interest rate never changes? If you don't understand how escrow works before buying a home, your first year of home ownership can come with some expensive surprises. In this video, I'll explain exactly what escrow is, why lenders use it, how it works in Texas, and how you might even avoid having an escrow account altogether. If you're planning to buy a home in Texas or you already own one, this is something you need to understand. So what is an escrow? Let's start with the basics. An escrow account is simply a separate account that your mortgage company uses to collect money for certain home-related expenses before they're due. Think of it as a savings account that's managed by your loan servicer. Instead of paying one large property tax bill at the end of the year and another large homeowner's insurance premium, your lender collects a small portion of those costs every month along with your mortgage payment. Then, when those bills come due, the lender pays them on your behalf using the money that's been building up in the escrow account. It isn't extra money you're paying. It's money you're paying earlier and spreading it out over 12 months. So what is generally included in your escrow? Well, in Texas, escrow usually covers two major expenses. First, your property taxes. Those property taxes may include taxes from your county, your city, if you're within city limits, your local school district, and if your home is located in a municipal utility district, or otherwise known as a MUD. Some communities may also have a PID, Public Improvement District, or PID assessment. While they're collected together on your property tax bill, they're often going to different taxing entities that fund things like schools, roads, emergency services, water infrastructure, and other local improvements. Second, your homeowner's insurance. Depending on your loan and where your home is located, your escrow account may also include flood insurance or other required insurance policies. Your monthly mortgage payment is often described as the acronym PITI, Principal, Interest, Taxes, and Insurance. The taxes and insurance portions are usually what make up your escrow payment. So why do escrow payments change? Here's the part that surprises many first-time homeowners. Your mortgage payment isn't always fixed. Even if you have a fixed rate mortgage, your monthly payments can still increase. Why? Because property taxes and insurance premiums change over time. If your home's assessed value increases, your property taxes may increase. If insurance premiums rise across Texas, your homeowner's insurance may also increase. Since your lender has to collect enough money to pay those bills, they'll adjust your escrow payment accordingly. That's why you sometimes hear homeowners say, my mortgage went up. In many cases, the loan payment itself didn't change. The escrow portion did. So you might be asking yourself, can you avoid escrow? Well, the answer is sometimes. Many lenders require escrow if your down payment is less than 20%. That's because the lender wants to reduce the risk that the property taxes or insurance won't be paid. However, if you put down at least 20% or meet your lender's requirements, you may be able to waive escrow entirely. If you do, you'll pay taxes and insurance yourself instead of having the lender manage them. Some homeowners prefer that because it gives them more control over their money. Others like escrow because it spreads those large expenses out over the year. Neither option is automatically better. It depends on your financial habits and what your lender allows. So why does this matter in Texas? Well, escrow is especially important to understand in Texas because property taxes here are often higher than in many other states. If you're looking at a home's current tax bill online, remember that it reflects the current owner's situation, not necessarily yours. After you purchase the home, the taxable value, exemptions, or reassessment can change, and your escrow payment may eventually adjust to reflect those new costs. Understanding that possibility before you buy can help you budget more accurately and avoid unpleasant surprises after closing. For an example, let's say your annual property taxes are $7,200 and your homeowner's insurance is $1,800. That's $9,000 per year. Instead of paying those bills all at once, your lender collects about $750 per month into your escrow account. When the tax and insurance bills come due, they're paid from that account. So at the end of the day, escrow is not complicated once you understand what it's doing. It simply is a way to collect money throughout the year so your property taxes and insurance are paid when they are due. But knowing how escrow works and why your monthly payment can change is one of the smartest things a Texas homebuyer can learn before closing. If this video helped you better understand buying a home in Texas, and what an escrow is, please consider subscribing to Lonestar Breakdown. I explain Texas government, property taxes, and other random Texas facts.